portfolio at this point in time. You currently have operations in Zimbabwe, South Africa, Ghana, Nigeria, Mozambique. You've got plans to open up operations in Equatorial Guinea, Botswana and Tanzania. And of course, we are starting to see rapid growth coming through for your company. Let's start off with the developments that you've got currently underway and looking at the other areas you're looking to go to, Equatorial Guinea, as I mentioned, Botswana and Tanzania. How many developments do you actually have underway in those countries?
Well, in Ghana, we are looking at about 2 more. We already have a management contract with an owner there in Accra. We're also looking at about 4 more in Nigeria. We currently have 5 at the moment. And Botswana, we're looking at just 1 more, which is the first one. Equatorial Guinea, we're looking at 2, possible 2. Well, I'm saying possible because the other one is an if-ish, but one is definite. And then Tanzania, we're looking at 1, and Kenya, we're looking at 1.
So that's rapid growth that we're seeing. Why are you embarking on such a massive capital expenditure program? Are we going to see the demand coming through for hotels in Sub-Saharan Africa?
Yeah, I would say that Sub-Saharan Africa, outside Southern Africa, the penetration of hotel rooms is very low, lower than South Africa, Zimbabwe, and Botswana. So when you go to the rest of West Africa and East Africa, there are real nice, good pockets there where you could, new rooms are really needed. And I must say that this expansion is not like it started yesterday or last year. It's been an expansion program on the cards, and we've been developing this. And as you know, to develop hotels in Africa takes anything from 3 years to 10 years.
Well, what segment of the market are you looking at here? Is it 5-star hotels? Is it the mid-tier, 3 to 4?
Mid-tier and also business hotels. Those are more resilient to what is going on in Africa, development being the major driver. So the resort leisure in much of the sub-Saharan destinations is not quite developed. So you've got to be careful when you go into the leisure market.
And obviously you've also picked various countries where there is going to be strong economic growth, and you're going to be looking at the tourism flows into these countries as well. And I mean, the ones that you are currently in, I mean, Ghana, Nigeria, Mozambique, we know that there are very strong tourism flows in there. Interesting to note, Zimbabwe, we know that a country that is changing quite rapidly. We've got the dollarization coming through as well. How have you seen the tourism scenario changing for Zimbabwe? Of course, a lot of business inflows as well, so you're also catering for those business people.
Yeah. The tourism inflows to Zimbabwe started off very low last year when the dollarization came, because then you could charge proper prices and also be able to plan better. But the market has been the business travel that has turned pretty quickly. Our city hotels in the past 4 months have been averaging anything about 70% occupancy, from as low as 30% occupancy. So, but the yield is still very low. It's 50% lower than similar yields you get in South Africa or in the region for that matter. But the leisure market is beginning to pick up. We're seeing about between 25 to 30% forward bookings for next year as we sit today in our Vic Falls areas and mostly in our resort areas. So there is a bit of, there's that pick up on there. But you must also know that in the resorts, we're sitting at 25% occupancy last year. So it's starting from a very low base. But that's very encouraging, because then at least we're beginning to make sense to the investment that is there. But our product also needs some kind of investment.
Well, tell us about the yields scenario in the likes of Nigeria and also the tourism flows there and occupancy rates. Give us a picture.
You take, for example, a RevPAR in Ghana. RevPAR currently in the past 6 months, you have a RevPAR of about $166 in Accra. And then you get to Nigeria, a RevPAR of $319. So, and then when you get to Zimbabwe, you have a RevPAR of $33. So there's no comparison in terms of those markets. And then you get to Botswana, the RevPAR is around $80. So that's really just to give you the markets we're playing around in. So the yields in West Africa are still very high, because there's still a huge demand of rooms. But we see that being rationalized in the next 5 years. So one has to be very careful in what type of hotels you're coming in with, and how resilient is that market that you're getting into.
And tell us about operations in Equatorial Guinea, because you are planning to open up operations there. I mean, a country that has, of course, been in dire straits for some time now. Tell us about what kind of yields you're expecting from this country.
Now, the Equatorial Guinea model is slightly different. First of all, there is also a skills-based shortage in Equatorial Guinea. So what we have done with government is to influence government to build a training school first to get the local skills for managing hotels better. The market for Equatorial Guinea does not justify a phenomenal increase in new hotel rooms, but there is a lot that is happening on the oil side in the expat community and the growth of the economy because of the oil. So we're looking at really the old hotels will probably just wash off in the long term. And so Equatorial Guinea is just, we have to get the skills base right. And
it sounds like as if you've also, implemented various strategies with regard to each country, because each country in Africa is vastly different. Unique, yeah. I was talking to the Residor CEO, Kurt Ritter, yesterday, and they're also planning on massive developments in Africa because they are seeing a lot of growth coming through. What kind of competition are you seeing from these multinational companies coming into Africa as opposed to you being a very African-based company? I mean, obviously you've got to really start doing your research properly and knowing what kind of challenges could come to the fore if you are operating such a vastly changing continent.
Yeah, I think that the biggest competitive advantage we have is that I think Africans understand Africa better, and we're able to actually navigate those. It's a lot of the game is on the partnerships that you form and how best you can put those partnerships together. The multinationals' advantage is their ability to bring in new investment, because hotels require huge investment upfront. So that's probably the competitive advantage. But we have a training school. That means on the skills side, we'll be ahead of them, and the know-how of the terrain we're working with. So that's probably the game that we're playing.
You, of course, listed on the Zimbabwe Stock Exchange. Tell us about funding. We know recently you tried to raise around $10 million in loans and trying to use property as a security. The board rejected that. So what is the way forward?
Well, let me bring a proper correction to that. We had set out to raise $35 million, of which $20 million was going to be in equity. We've managed to raise that 10 million in rights issue at the end of last year. The other 10 million, we're reserving it for a private placement. We have right now secured lines of credit of about 25 million. One of those was the 10 million that you're talking about, which needed an asset to secure. It was the particular asset that was a bit of a problem, but we're correcting that, and there should be an announcement in the next couple of weeks.
Shingi, are all your operations profitable at this point in time?
They are all, out of the 12 hotels we've got, 11 of them are profitable except for one.
Which is where? Which country?
No, I'm talking about in Zimbabwe.
In Zimbabwe, okay. Yeah, and the rest of the continent?
And the rest of the continent, yeah, and the rest of the continent, some of these, because we opened them in the past 15 months, they are still going through their runway of getting to operational efficiency and then profitability.